Good day all, Anish from BlackBull Markets. We're seeing a continuation of a trend of selling the metals and equities remaining volatile to the downside, with the Nasdaq down 2.5%, of course an outperform over the last 12 to 18 months as a US index. What we're going to be looking at today, although, is the Australian dollar against the US dollar, which somewhat comes in line with the negative commodity play that we've seen of late, especially in the crude oil market as well as the metals environment. We're seeing a lot of bearish momentum there, and of course this chart tells a really compelling story following that break that we saw mid-Feb of that key 78 cent mark, bringing the Aussie dollar up to 3-year highs, touching the 80 cent mark, completely rejecting that level within a 24-hour period, and then a sharp sell-off as the dollar gained strength, with of course those US 10 years increasing to those new yearly highs on the expectation, of course, of a Fed rate hike by 2022. We saw an appetite for the dollar, which brought this pair right back down to its 50% fib around the 77 cent level, and we are seeing the pair currently play support around that point, which is also at the 200-day moving average, where we've seen a previous rejection back in early Feb and then a build up above the 200-day moving average. So it's a pretty interesting momentum indicator if you're going to have a look at a potential continuation to the upside and looking for opportunities to potentially buy on pullbacks if you think that the Aussie dollar has legs in it to go and hit your 80 cent mark, or go surpass that 78 cent mark again, which of course was a significant resistance level since 2021 begun. So that is the play to the upside. However, with NFP approaching on Friday, and of course the dollar gaining some sort of momentum and strength coming back into the US dollar, we could see these very toppy FX markets start to turn to the downside, with dollar rising, as well as the dollar index, of course, holding that 90 level pretty perfectly as a support mark. It's pretty hard to break, so it's going to take something strong to break the dollar, especially with with gold falling, money floating back into the US dollar, equities also vulnerable. So if the dollar prints well, NFP prints well on Friday, remember unemployment's at 6.4%, so if you get a reduction in that, regardless of all that positive Australian economic data that we've seen this week, we could certainly see a break of that 77.34 cent mark and that 200-day moving average, putting a clear target of 76.69 in play, which is the 38.2% retracement from that 80 cent high to the 74 cent low that we saw late the latter stage of last year. Now, if I bring this to a higher time frame, we can really see how, of course, we are operating at those highs, and there is certainly space for the markets to come down. Let's get rid of this fib here. And the 200-day moving average on the daily chart sits around the 72 cent mark, so quite a way away. However, with the dollar turning around, we could certainly see supports being tested. We have a nice consolidation area here at the 76 cent mark, and of course we're sitting right on that 50% fib at the moment. So breaks of those supports could well bring into play, with dollar strength, new trading zones to the downside if we do get that dollar continuation heading into March. So do watch out for the Aussie dollar. It does remain vulnerable. 80 cents was pretty harshly rejected, so we could see sellers come back in, especially if we fail to clear 78 one more time. So do trade safe, and all the best of luck.